Hello everyone, welcome to my channel. So we are going through this series of fundamental analysis, and today we are planning to cover P by E, also known as price to earning ratio. So what is price to earning ratio? Price to earning ratio can be defined as current price of the stock divided by EPS, earning per share. Let's take an example of a company where company's price is around 100 rupees and EPS is 5. So the P by E ratio can be calculated as 100 by 5, which is 20. There is another way we can define this ratio, which is market capitalization divided by net earning of the company. Okay, so next thing, how will you use P by E or this particular ratio? So in order to understand P by E, let's take an example of a company where P by E ratio is at 10. And now let's compare it with another company where P by E ratio is 20. If we consider all other parameters remain same, then the question will be, which is a better company, A or B? In this example, company A is a better company because it's trading at low earning or low P by E. So a P by E ratio helps investor to determine if a stock is undervalued or overvalued relative to other companies in the same sector. Please note the word same sector. Okay, let's take a practical example of two IT giant company, Infosys and Wipro. And here we have around 14 year of chart of P by E ratio. So in this chart we are seeing at some point of time both the companies P by E ratio is coming down, where the Infosys P by E is coming down far more than Wipro, and then they are going up. So let's say we have two companies and both are good fundamental company. So when the P by E ratio of a good company is coming down, we try to enter the good company, and whenever it goes up and then becomes overvalued, we try to exit from the company. Now P by E can be applied on the index also. A lower index generally means the current market valuation are lower relative to earnings, which is a favorable scenario to the investor. Now we'll try to understand with the example of Nifty P by E. This is around 23 year of Nifty data, Nifty price to earning ratio data, and here we see from 1999 till 2022. Go back to 1999 where the P by E ratio was trading as low as around 10 or 11, and then it went till 28. Again it fall down roughly around 15, went till something around 18, again fall down till 10 or 11, like below 11 ratio. Okay, and from this point of time it went till 21. So this is how many of the PE fund or big fund or mutual fund they operate. Whenever they see the P by E ratio of a country or economy or whatever you say index or falling down drastically and they are coming down to a very low level, they try to dump their lump sum money. Like somebody is a PE fund and may hold 5,000 crore rupees, they may dump all 5,000 crore on these levels, or they partially deploy a lot of money here, and whenever it goes high here, somebody who put money here must have been nearly double at this price. So if you see from here to here, it's less than 1 year of time, the money is almost double. So somebody who kept money here will exit here. Again, somebody who exited here might prefer to enter when the PE again came down to near to the same level, nearly 10 or 11. So this is again becomes an entry point. And somebody who entered here, which is again 10, 11, this is again scenario in couple of years or 3-4 years where money gone more than double. So again exit point. So we can apply the PE on a one particular company also or index also, and whenever the PE ratio are going up, we can exit from the market. Whenever they are coming down, a very good investor scenario, we can enter into the market. Let's understand the concept of high PE. Though the company with high P in the market are considered to be overvalued. At the same time, they are considered as growth stock also. I'll take an example of DMart. DMart is trading at 167 times of its earning, which is very high if you compare to market. Like Nifty, we just has a range between 11 to something around 30 for more than 20 years. So somebody is 160 times means it's 6 to 10 times costly than the other Nifty company. Now, why market can give such a high valuation to a company? They are expecting a very good sale or very good growth. So, for example, DMart, we know it's a retail chain in India. Okay, so maybe DMart have, let's say, 100 store as of now in India. And for example, if market knows in next 3 years the DMart 100 store may become 200. So in that case, the market already knows the sale will nearly double or even more than double. So in those kind of scenarios, market can give high valuation to those company. Another example is SDFC Life, where the insurance penetration is less in India, and the market will have the data that okay, in next 5 years how much insurance penetration will increase. Relaxo Footwear is another example. So both Relaxo and SDFC Life are trading 99 times of earning, which is really a costly company. But at the same time, both are growth company. So as I already told, this indicates the positive future of the performance, and investors have higher expectation for the future earning growth and are willing to pay more than. Stock with high PE ratio can also be considered as overvalued, as just I told. Let's understand the low PE. Company with low price earning ratio are often considered to be value stock. So the price trade lower relative to its fundamental value. Okay. Now whenever you see, we saw in the example of Nifty, whenever the Nifty P coming down to 11, that becomes very low P. So in that case, if somebody want to dump money in any of the Nifty based company, generally it a bargain or very cheaply available. So that is the time investor will put the money, and whenever the market correct in this sense, market will go up. So the valuation will be high, like it comes down to 11 in few cases, and then it goes back to 28-30. In those cases, market people will exit from the market. So this is our scenario of low PE. Some of the example of low PE are Godavari Power and APL. We are just trading at 5 times of the their earning. Now I'm not saying these are value company, but I'm just telling that these are very cheaply available. Of course, like other parameter, P also will have some limitation. So let's look into P limitation. Now we have seen in the example that we try to compare Infosys versus Wipro. But can we compare Infosys with Tata Motor or Tata Steel? No. Infosys is a different industry, Tata Motor is a different industry, and Tata Steel is altogether different industry. So we cannot compare an IT company with an infrastructure company, because the requirement will be different for both the companies. So cheap stocks are often cheap for some reason. So if some company is cheap, there should be some reason. Okay, if the company is having low PE, there is likely to be negatory or advisor sentiment that must be researched further. So just because a company is cheaply available, we should not go and buy it. We have to do the research why the company is so cheaply available, and then we see if the fundamental are justifiable, then only one should buy those cheap company. Let's look into some of the other limitation of the PE. Now another example is somebody that is high PE doesn't mean it's bad, because some of the good performance company will have high PE and they will be continuously have high PE, like Bajaj Finance. So it is one of the example. At times a PE ratio can be misleading. Company can report a positive earning while having a negative cash flow, meaning they are spending more than the earning and they are showing a wrong PE, a wrong picture to the market. So before I complete, I'll take a quote from Warren Buffett. It says, I will tell you the secret of getting rich on the Wall Street. You try to be greedy when others are fearful and try to be fearful when others are greedy. So in our case, we can say you try to buy in the market when PE are low and try to sell in the market when PE are high. That's all guys. Thank you.